So what to make of it and how to sort of navigate these choppy waters? Sampath Reddy, the CIO at Bajaj Allianz Life Insurance, is with us now. Thanks so much, Sampath, for joining in. Good to have you on the show. So it's been a pretty turbulent couple of weeks for the market here. What sense do you make of things? And till we wait for the global headlines to settle, what parts of the market would you look at when one is to deploy fresh money?
Right. If you look at the current correction in the market, it is largely driven by the global development, especially some of the banks where we had seen severe ALM mismatch, and because of which the Fed had to intervene and help to solve the situation. If you see that whereas in the Indian market as such, when the interest rates moved up in the last 1 year or one and a half years, the mark-to-market impact and the most of the bonds which are there in the Indian market, let's say, is not really that high. So whereas if you see, global markets, especially the US and all, the interest rates were very low for the substantially long period of time, and when the interest rate moved up, 300, 400 basis points, the mark-to-market impact on some of these banks or NBFCs or lenders has been very, very high. But if you look at the same thing for India, broadly, if you see the outstanding, the government bonds of, let's say, 87 trillion rupees, largely issued mostly around the current, the interest rates, or, you want to take about 100 bits here and there. So the mark-to-market impact on the, the interest rate rise in the Indian financials has been, very, very small. I would say they're negligible. In that sense, our banking system is at a very, in a very strong pace. And not only that, if you see the Indian financials and lenders, the capital adequacy is at one of the best in terms of last, several years. If you take it, versus a required capital adequacy of 9.5, most of the banks are sitting around 14-15% kind of a capital adequacy. And also the asset quality, if you see that, most of the banks are also sitting in one of the best asset quality in terms of NPAs. So, the recent correction in the market, especially in the banking sector, in the wake of the global financial institutions' failures, I think is not warranted. That's how I would see that. But having said that, as the interest rates have been moving up since last 1.5 years, and because of the very high inflation levels, I think the market, the correction was somewhat anticipated, and the valuations were, slightly, premium to the most of the, the global emerging markets. And because of that, we have been somewhat cautious in the market. I think, we could see, maybe next couple of months more, we could see the subdued market trend will continue. But post that, at least towards the second half of 2023, we believe that interest rates will be, be coming down, and that's the time probably we'll see again a long, kind of a bullish market phase will begin in the Indian equities.
So the big driver of a strong bull market in the middle of 2023 is going to be interest rate cuts in India and globally?
Right. I think
what else will be the drive? Yeah.
Right. And if you see, last almost like 1.5 years, the market was subdued. In fact, equity returns were pretty much zero, almost like 1.5, 2 years. And, well, during the same period, earnings have grown substantially. So because of which valuations have corrected, that's one. And secondly, the interest rates coming down, and the growth, which was which will help the growth as well. So both the factors, valuations have corrected, and the interest rates coming down will lead to some sort of a re-rating of the PE multiple, and also will spur the growth. Apart from that, some of the measures that are taken by the the government as such in terms of the capital spending, if you see, these are the factors which I think will overall drive the growth in Indian companies' earnings, and interest rate reduction will also lead to re-rating of the stocks.
All right, got that. If we can ask you about some more of these individual sectors, what do you think of the pharma pack? Because there has been around an 8% cut this year itself in the overall in the index. Do you like anything from there? And if yes, what would you pick within pharma?
Right. In the pharma as such, if you see the Indian the domestic pharmaceutical market has been continuously doing well. Even the post-COVID also, the domestic pharmaceutical market continued to maintain a decent growth. So the domestic segment has never been a much of a problem. The problem was largely the export market, mainly the US market, and there was a tremendous amount of pricing pressure for the last 3 to 4 years. I think the extent of the pricing pressure that has been there in the last 2, 3, 4 years is getting abated, and also the valuations are somewhat, I think, is reasonable. Because of that reason, we continue to like the pharma sector. Both the domestic market continues to do well, and the export market is now, somewhat, I think, is bottoming out, I would say, in terms of pricing pressure. So because of that, I think, pharma is a good overweight sector for us.
So, Sampath, just your thoughts. I mean, I know that you represent the sector, but if you can speak, more generally, without, of course, taking names, what is changing for insurers? Suddenly, there's, some optimism coming in. The stocks, of course, have been beaten black and blue. Do you see this lasting? And beyond insurance as well, non-banking, non-insurance, anything else that you like in financials?
I think in the financial space, banking as such, we continue to like. And apart from that, if you see even asset management companies, they're also very good, high ROE companies, I would say. Their valuations have also corrected quite meaningfully. And some of the other infrastructure providers, whether it is, RTAs or, exchange is not, the major one is not listed, but even the credit rating agencies, they're all very high quality companies with, very good return on equity. I think, the whole host of the other infrastructure players in the financial services, whether it is, brokerages, whether it is, AMCs, whether it is, credit rating agencies, we like them. We like them in terms of, the kind of business quality that these businesses represent.
Any sectors where you foresee a lot of decline still left?
I think, maybe, next 3 to 4 months, probably as a max, we could see slightly more headwinds. I think, interest rates are still, 1 or 2 more large rounds of hikes could still be there. That's how we think. And also, going forward, we are getting into the monsoon season. How the monsoons will pan out will also play an important role. I think, because of that reason, we are thinking that maybe the second half of this calendar year, or somewhere middle of this calendar year onwards, the opportunity to deploy a good amount of money for long term, will be there. And of course, even now also from a longer term investor, valuations have corrected. But I think a few more months of subduedness in the market is possible, given that it's already for 14-15 months we are, markets have been somewhat range bound. We could see that this trend continuing for a couple of more months.
Your view is taken, right? The markets remain subdued, continue to consolidate for the next few months, and in the second half there is a pickup in the sentiment as well as in stock market levels. But any sector which you will avoid and not participate even in the second half, where you see the headwinds lasting beyond a couple of months, maybe for the next 12 to 18 months, any sectors which are headwinded?
Right. I think if you see the overall earnings growth in the market, our Nifty 50 earnings growth, around 12 to 14% is what is expected for next financial year. By and large, if you see, most of the growth is actually coming from the financial services sector, and followed by even auto is also coming out of a low base, is going to contribute to the good growth in earnings. So these are the two sectors we continue to like, and the FMCG and pharma and IT services companies, by and large, they will just grow within the the industry level kind of growth in the range of about 10% kind of an earnings growth. They would neither be adding to the overall growth of the Nifty 50 nor depressing that. But the sectors probably which will cause a little bit of a the downward spiral, downward pressure to the Nifty 50 earnings growth looks like largely the commodities and also to some extent cement. I think these are the two sectors probably seeing a slight amount of degrowth or a low growth in earnings. Probably apart from these two, I think the rest of the segment next sectors look quite good.
All right. Commodities and cement could be a little bit more of a prolonged pressure in these names. Sampath, one final question. We were talking about valuations correcting. Do you think valuations have corrected enough in some of the new age companies for them to have your interest? Any of them?
I think that's interesting thing. New age companies have had a very high valuations level about 1.5 years back. If you recall, that is a time when the interest rate was very low and a lot of liquidity was available. When the broader economic situation is like that, the valuations for these new age businesses really got rich, because for them the cash flows are going to come far into the future. Not the cash flows are not here to in the next 3 to 5 years or so. So when you see the DCF value of some of these companies where the free cash flows are far ended, when the interest rate goes up and the liquidity becomes tight, gets tightened, the valuation compression will be much more severe. I think that's what we have seen in the last 1 year or so. I think we would still think that the new age companies will, valuations are still rich given the way the interest rates are, given the way the liquidity situation is prevailing in the current global markets and as well as India. So liquidity will continue to recede and interest rate will, not come down so much sharply. Because of that backdrop, I think new age companies, I would still think that they may take a lot more time to recover rather than come to their previous highs.
All right, still not looking at the new age companies. It may take a while. Sampath, thanks a lot for joining us and taking us through your call on the markets today. With that, we do need to get into a short break.